We need to look at the NASDAQ here. Guess what? It has just turned positive for February, albeit slightly. So remember, February was terrible for the NASDAQ. Now, not so much. And we have a great day on the NASDAQ. We are moving up more than 80 points at the moment. So as we watch this big rally with the Dow up nearly 400 points, the NASDAQ is definitely coming along for the ride. Speaking of the correction in February, Goldman Sachs pointing out something very interesting about that dramatic moment on February 5th, where the market fell 1,100 points. Its hedge fund VIP index. This is an ETF that consists of stocks that matter most to hundreds of hedge funds. It outperformed the S&P 500 during the turbulent record. Now, based on that, Goldman is surmising the technical factors, nothing fundamental, were behind that sell-off, and core fundamentals are doing fine. Seth Merrin is the CEO of Liquidnet, an electronic trading network. Its members have $15 trillion in equity assets. This is interesting because, let's just take the jargon out of it, these stocks did not sell off when it came to the VIP hedge funds because they looked and said, well, it's just something weird, maybe these algorithmic trades or more volatility, but it's not the substantive moves or the value of these companies that is somehow negative now.
You know that nothing goes to complete crap in a matter of minutes or hours. So, you know, a 1,000-point drop, there was nothing fundamentally wrong with the companies from one day to the next. You know, Liquidnet is a network of 900 of the largest asset managers around the world. And what we saw was that there was no panic at all. They stood back.
With institutional big investors, right?
That's right. So roughly 75–80% of all the institutionally managed assets in the United States are members of the Liquidnet community. So we didn't see massive swings or massive buying or selling. You know, I think that some people, some of our members certainly opportunistically stepped in because they've seen this kind of market. Mm-hmm. The big difference between institutions and the retail investors that they've seen it before, they're not panicking. They could take advantage of this volatility. And for the first time in perhaps a decade, the active managers have a real opportunity at outperforming.
Okay, so I am hearing you say there wasn't some horrific headline from North Korea sending off another missile, or that somebody important had died who mattered to the markets, or something that the Fed did. It had to be these high-frequency trading machines, computer-driven?
So I think that those are great examples. So we've seen lots of North Korea missiles, and we've seen lots of macro issues that have not affected the volatility over the last few years, which we thought and historically would have. So I think that the markets fundamentally have changed, and I think that we have to forget about all of the drivers historically that have created volatility that we remember and that we talk about. Today, we've seen an enormous amount of assets come into the passively managed area. So that's ETFs, and that's just passively managed funds.
Or like what Buffett likes to say, buy the S&P index. And in his annual shareholder letter over the weekend, he said, had you just bought the S&P 10 years ago, you would have outperformed the fancy hedge fund guys who take a lot of money in fees.
Yes. So in the last 10 years, those types of funds managed about 24% about 10 years ago. Today, it's almost half of all investable assets in this country. That changes the dynamics of the market.
But as the market is up 416 points for the Dow right now, again, that's only 30 stocks, but the S&P is charging ahead. Do we need to understand that high-frequency or algorithmic trades where machines just start tripping wires and things like that and selling or buying, depending on which levels have been programmed into them, do we need to look at the impact that they have on the financial markets now and understand that everything has really changed?
We do, because those two are new entrants into the financial ecosystem, but they always need a catalyst. So with the S&P, you have $9 trillion worth of funds in the S&P 500. There's never been that much concentration in such few names. As money comes in, the markets themselves are very shallow. Those funds go in, and they have to be invested in those stocks. The high-frequency traders see that as a supply-demand imbalance, and they exacerbate the problem.
That's all they're looking at. They're not looking at, oh, Starbucks did something wrong or didn't have same-store sales that met expectations. It's just levels.
It's not fundamentally based at all.
Is that what you're saying?
Absolutely.
Seth Merrin of Liquidnet, thank you very much.